Hey guys, I'm Roger Herring. I'm the Investor's Accountant. It's great to be with you today. Now, normally on a Friday, we would put up an episode of Ask Roger, but this week I wanted to tell you about a meeting that I had with a young couple. And in about the first 4 minutes of meeting with them, I saved them between $15,000 to $20,000 by doing one simple thing on their taxes. One. So, I want to explain to you today what I did and how it works. And you know what, guys? It's one of the simplest strategies. We use it all the time, but people forget about it, or they don't know about it, or they've heard about it, or they think it's complicated, so they don't do it. It's simple, and it will save you money every single year. So let's go to the board, and let me just draw this out. All right, here we are on the whiteboard. Now, most people, when they are setting up the business, the most common form of business in the United States, so here's your business, is a sole proprietorship, an SP. And this could be a totally unincorporated business, or a lot of times, it's an LLC. Now, I don't like holding out to the public if I'm not in an LLC. I want some legal protection for what I do. So I'm going to have an LLC and I'm going to carry liability insurance. Now, this LLC is a sole proprietorship. So what exactly does that mean? That means there's no difference in the eyes of the IRS between you and your business. This is what's called a disregarded entity. You are going to file this now on your 1040 on Schedule C, which happens to be the number one most audited schedule in the entire system. Okay, that alone should be a hint that you need to do it another way. Okay, so here's what happens when you are a sole proprietor. And I'm just going to use round numbers. These have nothing to do with the client that I talked to. Let's just assume that these guys made $100,000. Now, because there's no difference, Schedule C is part of the 1040, and it's going to be added with your other income, and then you're going to get to take your standard deduction or your itemized deduction, and you're going to be able to take your dependent credits and all that, and then you have your income tax. But guess what? There's another kind of tax that you have to pay as a sole proprietor, and it's called the self-employment tax. And here's the deal, guys. This is how Uncle Sam gets Social Security and Medicare out of the self-employed. And because there's no employee or employer, normally the employee pays half and the employer pays the other half, you get to pay the whole tax. And how much is that? It is 15.3% of this bottom line $100,000 that you made. So if you do the math, 100K times 0.153, very simply, that's $15,300 in SE tax. Ouch. And guess what, guys? You may not owe a dime up here in income tax. You may not owe a dime of income tax off that 100K. But no matter what, you're going to owe that $15,300 in self-employment tax because they are two different taxes. No, it doesn't matter how many deductions you have on Schedule A. Okay, it doesn't matter how many dependent credits you have. This $15,300 is based off of the bottom line of your business, and that was what? $100,000. So, what is the answer? Let's just say that we have the same situation. We have a limited liability company currently taxed as a sole proprietorship. Well, the answer is to not be a sole proprietor. Instead, let's be an S Corp. So, how do you become an S Corp? You file a form which is Form 2553. And that's going to let you be an S Corp as of a certain date. Now, there are rules behind that, and I'm not going to go too deep, but what I'm going to tell you is if you forgot to file the S election and you're within your first 3 years, we can still do it. After the first 3 years, there's only one time each year that we can do it, and that is between January to March 15th. So, how does this work now? Here's my 100K. Now that I am an S corporation, I become my own employee. And what does an employee get? A salary. How much should that salary be? Well, according to the handy dandy chart I have, at $100,000, I should be paying myself a salary of $40,000. So that leaves $60,000. Well, what happens to it? Well, here's the deal, guys. In the S corporation, you're still paying income tax on this $100,000, except now you've got a $40,000 W-2 that goes to your return, and you're going to have a form called a K-1 for $60,000. So the income tax doesn't change. This strategy helps you to avoid self-employment. So as an S corp, we're no longer paying self-employment tax, but we do have to pay payroll tax on what? The salary, the $40,000. So 40K times 0.153 is $6,120. Up here you had to pay 15.3 off of that 100 grand. Down here you have to pay 6120 off of 100 grand. So, do you want to pay 15,300 or do you want to pay 6120? That savings is $9,180. And guys, this occurs every single year. Okay? This is the simplest move that can be. All you have to do is file a paper and get with a good accountant that knows what they're doing. Don't try and do this on your own. It's not that complicated, and it's going to save you a pile of money. Okay? Let's flip out of this, go back to the main screen. You know, I love the S corporation. I am an S corporation. The S corporation should be the number one tax planning entity that you have. In fact, check out my other video of why you should now have anybody else in your S corporation other than you or maybe your spouse. Okay? I hope you've enjoyed today. If you haven't already made an S election, you might want to think about it. Now, here's the deal. If you're making $30,000 or less, don't worry about it. If you're making between 30 and 50, think about it. If you're making over $50,000 a year, it's a no-brainer. The S election will save you money. Don't try and do this yourself. Please seek out someone that can help you, that is a competent professional, or reach out to my team. We can help you. Till the next time, gang, Roger out.